Welcome back. Now, as we probably all know by now, hedge funds got beaten up pretty badly last year. But managed futures, though, did relatively well. One of the few bright spots in an otherwise very grim investment environment. Now, managed futures have been around for decades for big institutional money, but now they're gaining popularity with savvy retail investors. We sat down and talked with Aaron Smith from Superfund about what you need to know.
A managed futures fund is simply a diversified pool of futures products. So everything from stock indexes, interest rates, currencies, that's about half of our portfolio. The other half of our portfolio consists of energies, metals, agricultural products. I mean, basically everything from soybeans to rice to Japanese yen to DAX futures. It's an incredibly diversified pool. But the key thing about managed futures and why we're able to be successful in the long run is the fact that in any of those markets we could be long or short depending on the trend. So managed futures is one of those few investments that can actually profit when the market is going down.
So it kind of sounds a lot like a hedge fund, though.
I think it's similar to a hedge fund strategy in the sense that it's very flexible and that we can make money in a very dynamic way, not just when the market is going up. On the other hand, I think it's very different from hedge funds because, number one, the correlation of managed futures funds to all other alternative investment strategies is quite low. And number two, managed futures is a very highly regulated asset class.
But at the end of the day, though, does it not boil down to strategy, how you run your funds?
Absolutely. And what we do is we trust our investment strategy to a system. Everything we do is fully systematic. And think about it. How can you process over 100 markets worldwide? We use a computer system because we think that this is a much more efficient way to crunch all the data that there is out there.
So what you're saying is this is quant stuff. This is systematic program trade, black box.
That's right. It's purely systematic, and the advantage of that is that you take out all the human emotions out of the trading process. So, for example, in a bull market, investors tend to get overconfident or greedy. In a bear market, they tend to panic or get too scared. But the system doesn't have any emotions. It just follows the discipline that has proven itself over quite a long period of time.
And Superfund, or your super funds, not just did well last year, did very well last year when just about everybody else got killed.
Well, yes, our Superfund A was up 35% last year, Superfund B was up 50%, and our most aggressive trading strategy, Superfund C, was up about 74% just for the year. But more important than that, Martin, is the long run performance. Managed futures since 1980 have outperformed stocks, bonds, real estate.
All right, but what about this year? Are managed futures going to make people money this year?
Well, it's not about the short term. It's all about what you can achieve over the next 2 to 3 years. And I think over the next 2 to 3 years, managed futures will be a winning strategy. I can't promise what we'll do in 3 months or 6 months, but I can say that all this global uncertainty will lend itself to very strong trends. And we don't care at Superfund if those trends are up or if they're down. Just as long as there's clear trends that we can follow in the market from a technical standpoint, then we can profit for our investors.
Let's take your average investor or potential investor walks into the Superfund offices. You give them your spiel, but at the same time you need to tell them what the risks are. What do you tell them?
Well, there's no such thing as a free lunch on Wall Street. And with managed futures, the primary risk is going to be volatility. You're going to have substantial month-over-month fluctuations, similar to if you bought an individual stock. So our volatility at Superfund over the past 13 years has been a little over 20% per annum.
What about gearing, though? Because, we know that that's how, before they got killed, a lot of the hedge funds made incredible returns. Managed futures, do they rely or depend on leverage?
Alternative strategies like hedge funds that depend on leverage may not be successful as they were in the past. With managed futures, it's really a different animal because we don't have to borrow any money to create our returns. It's automatically provided by the futures exchange. So when we're trading, we only need a small amount of the money to put down as margin, and the rest of the money, usually about 80% of our capital, we keep in treasuries and other government sovereign instruments that really sort of deleverage the futures contract. And one of the best kept secrets about managed futures is that we actually make interest on 100% of our portfolio, because the part that we use for margin is paid interest by the clearing firm, and the part that we keep in government securities also is earning interest. So that's another great advantage of managed futures.